Whether your faith in PIMCO is shaken or not, this is a good reason for you to pay close attention to your portfolio. But you shouldn't necessarily pull out of PIMCO or scale back on bonds. That's according to money manager Doug Flynn. He's the co-founder of Flynn Zito Capital Management. He joins me now from his offices in Garden City, New York. Doug, two things going on here. One is PIMCO. Lots of people are invested in PIMCO. Lots of people don't have a lot of choices but to be invested in PIMCO by virtue of what their companies offer if it's in a 401k. Should you be worried if you are invested in PIMCO right now?
Well, it's kind of too early to tell, to be honest with you, whether they should worry about it. That fund is managed directly by Bill Gross, and so what you're paying for versus a total bond market index fund is hopefully some of the advantage that he might have. If you look at historically, he has been able to bring additional return over the index, and that's what you're paying for. But what happens is that fund has been in outflows every month for a long time.
Which means people have been redeeming their money. It's been losing money. Not losing money, but people have been taking their money out of the fund.
That's right. So think of yourself as a portfolio manager. You sign on to your terminal that day and you say, oh, I'd like to buy some bonds today. And you say, oh, wait a second, I have to sell. So you're selling into where you would normally like to be purchasing things. And I think that's where some of the discrepancy is. With the ETF, which is newer and smaller, they weren't in outflows. So he had the opportunity to buy some bonds that he might have had to sell from the actual mutual fund, and that might account for some of the difference in the
Well, let's look at the difference. I'm going to show my viewers. I've got a chart here. The total return fund is the orange line. That's the big fund, the $222 billion fund that you say has been, people have been taking their money out of. The green is the ETF. That's the bond fund. And they mimic each other, but the return in that green is positive. It's above zero. And there's some space between it and the other return. What's the most logical explanation?
Well, that's part of it. I think it definitely has to do with the fact that a fund that's new and has inflows every day when the manager signs on their computer, they do get with that extra cash to buy investments. And that's where some of this gets to the heart of. He was buying securities that he thought were undervalued, and then there was some possible revaluation through a third-party service that values these bonds. He didn't really have that same opportunity in the larger fund, the fund that's in everyone's 401k, because he really couldn't be buying a lot if every day he had to be selling to raise money to pay these people out who were redeeming. Yeah. So that has something to do with it. Now, whether there was price discrepancies and things that make up for some of that difference, I think that goes to the heart of what this investigation will find out. But that's part of the problem, is you don't know that yet. And generally, you try to stay away from funds that are in a constant outflow scenario because they have a harder time keeping pace with other managers and other funds that are not in that scenario.
Right, because if they've got to sell stuff, if they've got to sell stuff to pay investors out, that's missing an opportunity to buy and invest in stuff.
That's right. It's typically at the worst time.
Let me ask you this. Interest rates seem to be moving up. How should you be thinking about bonds in your portfolio right now?
So if you look in your 401k and you look at 2013 as a great year to see the return of the bond funds you had in your 401k. The bond market index was negative 2% last year. The PIMCO fund was just about right there. But if all the bond funds you have in your 401k also have negative returns for 2013, that was a year when interest rates went up. Now this year it's returned and things are positive again, but that was a little bit of a sign, a little bit of a snippet of what you can expect when rates begin to go up. If you don't have one bond fund in there that had positive performance last year, it's time to get on the phone and call your provider and ask for bond funds that do. We don't want people to get afraid that they can't invest in bonds. The stock market's getting higher and higher. Most people need some fixed income or bonds. But if the only bond funds you have in your 401k were negative last year, you don't have the right kind of bond funds. And those are the kinds of things that you want to see, additional choices in there. There are bonds and bond funds that do well when rates go up. So I'm not afraid of bonds overall. I'm just afraid of regular indexing and other bond funds that don't have the same kind of opportunity others do.
Doug, always a pleasure to talk to you. Doug Flynn is a co-founder of Flynn Zito Capital Management, joining us from Garden City, Long Island. Trust is a big factor in choosing where to invest your money.